The earnings calendar reached its peak this week, with hyperscalers Meta and Microsoft reporting their quarterly results on Wednesday local time. The tech giants delivered sharply different messages to investors, one showing how its strong performance could support the company's heavy infrastructure investments, while the other showing the burden it causes. For more, we turn to our Kim Bo-kyoung here in the studio. Welcome back, Bo-kyoung.
Thank you for having me, Tani.
So, Bo-kyoung, let's start with how Meta and Microsoft did for the second quarter.
Right, so both of the companies beat the market's revenue expectations. First of all, Microsoft reported a revenue of around $90 billion which is around 18% increase on year, surpassing market expectations of $87 billion Net income rose 31% on year to $35.77 billion, while adjusted earnings per share, or EPS, came in at $4.74, beating the market forecast. Meta, meanwhile, posted revenue of $60.80 billion which slightly beat analysts' expectations of $60.22 billion. This marks 27% revenue growth year over year.
So they both reported quarterly revenue that beats market expectations, like you said, but the market reactions were quite different. What led to this difference, Bo-kyoung?
Right. So although both of the companies showed quite strong performance in terms of revenue, what mattered the most was the returns of AI investments and profitability. In terms of Microsoft, due to ballooning investment in AI infrastructure, free cash flow fell 23% on year to $19.64 billion. But it exceeded Wall Street's estimate of a little more than $13 billion, showing that the company's AI investments were indeed translating into profits. This was mainly driven by its cloud business, Azure, surpassing $100 billion in annual revenue for the first time, and the company's AI productivity tool, Microsoft 365 Copilot, which had more than 30 million subscribers. Meanwhile, in terms of Meta, revenue narrowly exceeded analyst forecasts, but both operating and net income fell after spending on AI infrastructure jumped more than 55% from a year earlier. Free cash flow plunged more than 90% on year to $780 million as capital expenditures surged.
Meta platforms faced pressure from below consensus revenue guidance and slower ad impression growth, while Microsoft rallied on stronger forward guidance, rapid growth in paid 365 Copilot users, and lower capital spending planned. These differences made two stock shares diverge.
So what investors are seeing right now is not just revenue, but whether massive spending is translating into meaningful financial returns and how fast their cash flow is cratering. Another expert says big tech companies are going through a transitional phase as they are engaging in an increasingly expensive race to build next-generation computing capacity, and that the market would have to continue seeing how this could lead to profitability.
AI-related earnings have yet to show clear results, and cash flow is unlikely to improve significantly through next year. The key focus will be whether revenue and operating profits can grow meaningfully.
Well, Bo-kyoung, ultimately, what investors here in Korea are most interested in is how this will impact the shares of major Korean chip makers like Samsung Electronics and SK Hynix. What's experts' view on this?
So major tech companies' continued AI spending is indeed a plus for South Korean chip makers, like you said, SK Hynix and Samsung Electronics. Meta raised the lower end of its CapEx guidance, while Microsoft's second quarter CapEx jumped more than 70% from a year earlier. Now, in the near term, that should support semiconductor demand. The bigger question is how long this investment cycle can last.
Rising capital spending is a positive for Samsung Electronics and SK Hynix, but big tech's continued AI investment is starting to resemble a high-stakes race. If some players are forced to scale back or drop out, it could raise concerns about the semiconductor market and weigh on the industry.
Alrighty, Bo-kyoung, thank you for the wrap-up today.
Thank you.